On this hot sheet, I discuss minutes from July's Fed meeting just released yesterday, the US 30-year rate, and what Redfin CEO Glenn Kelman is saying about the real estate market. Today is Thursday, August 17th, 2023. I am Byron Lazine, and your hot sheet starts now. Okay, a little bit of a hot day yesterday. By the way, you can use code HOT to get 10% off of BAMX, where you get all of our daily downloads from the hot sheet and all of our best content here at BAM. Hot day because we had the highest bond yield since 2008. So people were comparing us to the GFC, the Great Financial Crisis. We don't have to go over and over that again because we know that we are nowhere near that situation in the way we've lent out mortgages and all of the credit requirements that have been adjusted in 2010 and even before that. Okay, so the Fed released their minutes, and this has pushed up the 10-year yield, which we're going to get into here in just a second. It's also pushing up the 30-year fixed, of course, as we follow the 10-year. So in the Fed minutes, let's start there. They are showing a significant upside risk to potential inflation. Okay, so they're still seeing risk to inflation, even though we've had 2 great months of lowering inflation. They still want to be cautious on what could happen if we get a bounce back up. Some Fed officials, though, according to Wall Street Journal, are turning cautious about raising rates too high. And this is, you can find this in the minutes. I'll have that linked up in BAMX, of course. Minutes of the July policy meeting released Wednesday said some officials thought the risk of raising rates too much versus too little had become more two-sided, and it was important that the committee's decisions balance the risk of an inadvertent over-tightening of policy against the cost of inefficient tightening. At the same time, officials saw significant risk that inflation might not fall as much as they expect, which could require them to raise rates again this year, the minute said. So they're like riding the fence, okay? And they've got their big Jackson Hole meeting, I think, next week, the FOMC. They get together, or maybe that's the September meeting. I'm not sure, but they're going to be in Jackson Hole soon. Good for them on your dollar, on your taxpayer dollar. They get to enjoy Jackson Hole and discuss what they're going to do with the federal interest rate, but they're really riding the fence here. We know that they had an increase last time, obviously, and they just really don't know what they're going to do. Some of the last 24 hours might impact them one way or the other. There's been some big moves here in the last 24 hours, with the 10-year being the highest since 2008, with the 30-year being in a 22-year high range as well. We're probably going to hit a 20-plus year high today as we make a new year-to-date high on the 30-year fix. What did Jerome Powell, or the FOMC rather, say specifically about the real estate market in the minutes that were released yesterday? Here it is. Credit in the residential mortgage market remained broadly available for high credit score borrowers who met standard conforming low criteria. Another way of saying that is if you don't have good credit, it's incredibly difficult for you to purchase a house. It's becoming more and more unaffordable to buy real estate for many potential home shoppers across the U.S. Only modest net percentages of banks in the July SLOOS reported tightening standards for mortgage loans eligible to be purchased by government-sponsored enterprises, while a moderate net percentage of banks reported expecting to tighten lending standards further for these loans over the second half of the year, okay? A moderate net percentage of banks reported expecting to tighten lending standards further for these loans over the second half of the year. Okay, moderate, not extreme, but you're going to continue to see less capital in the mortgage market is what that's saying. Meanwhile, the availability of mortgage credit remained tighter for households with lower credit scores at levels close to those prevailing before the pandemic. Banks reported in the SLO OS that they had tightened standards for certain categories of residential real estate loans to be held on their balance sheets, such as jumbo loans and home equity lines of credit. In addition, banks reported expecting to tighten standards for jumbo loans during the remainder of 2023. And that was really it, where they got specific on the 10-page minutes report for housing. That was kind of it, just related to how much credit is going to be out there. The more the interest rate continues to move up like it has been day after day here recently, that's another way of just tightening the credit available, because less and less people can afford to go out there and get a 7.25, 7.5, potentially mortgage rate. I certainly don't want to see an 8 in front of it. Okay. But that's maybe where we're heading. All right. This morning, on Bloomberg, global banks are positioned to outperform within 6 to 12 months because central banks are getting close to the end of the rate hike cycles. But treasuries have also been under pressure by expectations the U.S. government will issue more bonds. This is where there's a thought that this 10 years is going to keep going up, which is going to keep pushing the 30-year up. There's expectations, okay, that the U.S. government will issue more bonds in the coming quarter to plug widening federal deficits. I mean, this is a real thing with the amount of money that we're borrowing. If we keep asking for more money outside of the budget, you see DC do that as often as they can, that we're going to have to issue more bonds in the coming quarter and plug these federal deficits. That will increase the 10-year yield. The more we borrow, the more we have to make that debt attractive. The U.S. 10-year yields have jumped more than 30 basis points in August alone, set for the biggest monthly increase since February. Again, this is a 15-year high. The Treasury is likely to boost auction sizes in November and February. Okay, so if we boost auction sizes, meaning selling more, then, and this is according to fund manager at PAC Investment Management, this may pressure yields higher again unless inflation comes back down. Okay, so we need to continue to see inflation come down. We need to see rents come down, or we need to actually see, the CPI data report rents in real time, which would pull it down as well. But we need to see rents come down. There's no question about that. If we start to see inflation go up and we have yields going higher, that's a recipe for disaster on getting a 30-year fixed to start heading back down. I think it's pretty safe to say a lot of these projections that are they're still unchanged. I mean, Mortgage Banker Association hasn't changed theirs, saying at 5.9 for the 30-year fix in December. It's pretty safe to say these are not likely to come true. Okay. But maybe I'm wrong. Okay. We've had bigger drops in the past. Okay. If you look back in November here, we had a significant drop in about a day there. We had one there. Look at this nice drop. You remember these days? Don't show this to buyers. February 2nd, 2023, 599 was a low for the year. But look at this drop here. Look at this drop here. With this one, these are significant drops. If we go to, and this is a screenshot, obviously here, we are essentially back to the peak of last year. If you just draw a straight line, there was lots of opportunity here coming into the beginning of the year. There was lots of opportunity here in April and May for buyers. Those opportunities are wiped out at this point. But if we go to the live chart for the 30-year fixed, I'll switch over to that on Mortgage News Daily. Okay, and I've just got the 30-year fixed up. I don't have the you can switch it anywhere you want, 15-year, 30-year FHA, all this. I just got the 30-year fixed mortgage. So we're just going to take a look at that. All right. This drop right here back on Wednesday, November 9th, when we went from 7.22 to on November the 10th to 6.62. We had a 0.6% drop in a day right there. So this can happen, okay? Like maybe Mortgage Banker Association sees something other than what all the tea leaves are reading right now between now and the end of the year, and that's why they're holding firm at 5.9 by the end of December. To me, it would mean we're going to see a lot of job loss between now and then for it to pull down in that way. But what do I know? I'm just, all we can do is go day to day here, and it seems like that's what the Fed's doing on their minutes is going day to day. But here you go. You've got another big drop that happened in November 30th from 6.63 to 6.29 by December 1st. You have a big drop here, 7.03 on March 7th, and by March 13th, we were at 6.5. And you can see a number of these significant drops, very volatile 30-year fixed rate right now. All right. If we back up 5 years, you rarely saw volatility like you're seeing over here on the right side of this chart, which was what we've been experiencing the last year and a half. These are pretty tight lines. If you max this thing out, you saw some volatility. You see a lot of volatility now, and not as significant declines going back into 2000. I'm sorry, this is not giving me all the dates I want here. Why not? Reset Zoom. Let's actually max this out. This is only showing me 2009. If we go all the way back, I'll refresh the screen here for a second. If we go all the way back to 71, this was the last inflationary, like, big time frame right here. Those like Volcker years everybody talks about. You see a lot of volatility. Other than that, not as much volatility. Certainly not in the last 15 years. Pretty tight range. And then all of a sudden now we have these big significant peaks and valleys on the 30-year fix. So they can change in a day. So that's a little bit of hope, I guess, for you that these things could turn around to the benefit of home shoppers right now, because it's becoming incredibly hard for home shoppers to compete. Some of the other things that are just maybe not in the favor of the 10-year going down anytime soon. Okay. And some of these things do seem counterintuitive. One would be the jobs report that just came out this morning. Okay. So the U.S. market, job market continues to be very resilient. Applications for jobless claims fell 11,000 last week. Initial claims decreased in California, Texas, and Michigan. So applications for unemployment are going down. Job market continues to be strong. There was just like a bombshell projection from the Federal Reserve Bank of Atlanta that came out in the last 24 hours. Atlanta Federal Reserve is projecting that Q3 of the GDP is going to be at 6%. The range of the top 10 and bottom 10 average forecasts has us at 1.5%. I mean, if we're close to this number, that's going to show a sign of recession is nowhere near. The economy is screaming, which is what Bloomberg's talking about this morning. That, okay, if that's the case, if you've got a GDP that is screaming, if you've got a job market that's very resilient, then you're going to have some concerns here that the Fed, the FOMC in September is going to raise these rates again. Of course, the Fed minutes from yesterday tell us that they really don't know which way to move on that. They're sitting on both sides of the fence. But that is a something that we're going to have to watch. The 10-year continues to move up right now. Again, the 10-year is at a 15-year high. Let's see where it is right now. We'll sign off before the show. I mean, this is, I put my head down when I look at this. 4.283. It means we're going to have another big day here on the 30-year fixed, which yesterday we had our year-to-date high at 7.34. Last year's year-to-date was 7.37. We'll get the Freddie Mac 30-year fixed weekly that comes out. That'll be over 7. We're almost, above every high for last year when we look at all of the different ways to look at the 30-year fixed. The 30-year fixed daily is going to go up above the 737 today. I mean, it's pretty evident here with the 10-year, and we're getting close to 7.5 territory. And so you will see that buyers are going to drop out of the market. This is just what's happening right now. It's becoming unaffordable for some. Here's a number. Here's some numbers that Lance Lambert put together. Okay, and this table will be down below. It'll be available for BAMX members in the daily download inside of BAMX. Okay, if U.S. incomes right now spiked 69%, there's a 0.0% chance that is going to happen. Okay, in like the near future, U.S. income spikes 69%. Then we would return to pre-pandemic housing affordability levels. So January 2020, housing affordability, buyers need income to spike 69% to get to that point. If U.S. home prices fell 41%, I can promise you with over 4 out of 10 homeowners owning their property cash, with the strong job market and all of those things, home prices aren't falling 40%. The strength of the mortgage, we're at all-time low delinquency rates on mortgages right now because of the changes that were made after the great financial crisis on credit lending. We lend like 10 times less mortgage loans than we did back then. All of those different reasons why U.S. home prices aren't dropping 41%. We'd return to pre-pandemic affordability. So this, like Logan Motoshami at Housing Wire says he doesn't believe in the lock-in effect. What he's saying is he believes that housing has become unaffordable. He talks about this savagely unhealthy market. I think the lock-in effect, we're going to get to Glenn Kelman's comments here from Redfin CEO in a second. He kind of says the same thing. Yeah, I've been calling it cold war. They're saying the same thing. Okay. But it's a real thing. And what his argument is, well, people aren't trapped in these 7% interest rates. If they want to make a move, they'll make a move. But when they do the math that Lance put together from Fortune, it's pretty evident on paper, the move doesn't make a whole lot of sense unless they have, some orders to leave due to their job or divorce or marriage or kids. It's a big driving factor getting them to move, other than just wanting to. If mortgage rates fell 4.3 percentage points from the 7.25 range to about 3, then we'd also return to pre-pandemic affordability. Promise you that's not happening. Okay. We may not see 3 at any point in the next 5 years. Okay. There are no projections that say that. There are no signs in the economy that show that. And if we get to 3% 30-year fixed, it means we just went through a devastating recession, devastating job loss for us to get back to 3 or below anywhere in the near future on mortgage rates. So where's the affordability coming from? Okay, that's part of the problem. Let's go to Glenn Kelman's comments. Glenn Kelman, of course, is the CEO of Redfin. The headline here on Fox Business, who he spoke to yesterday, says real estate brokerage giant, meaning Redfin, predicts a tough market for the remainder of 2023. Okay, there's U.S. home buyers and renters don't have much optimism about the market right now, which is interesting because agents in our agent sentiment survey with 1000 Watt that BAM and 1000 Watt partnered on, agents, like 9 out of 10 of them, have extreme optimism about the next 6 months. I'm urging agents to have realistic optimism. Preparation is the best form of optimism to me, and being ready to actually expand hours, expand conversations, do the right investments on your business over these next 4 or 5 months is going to give you more optimism than just crossing your fingers and hoping the 30-year comes down, because there's no tea leaves that are telling me that that's going to be the case. Glenn's calling it a standstill. The market's at a standstill. And he says sales volume is absolutely rock bottom. So sales transactions, the amount of units moving. The people who need to sell won't do it because they don't want to give up their mortgage. So he really does. He's a buyer of the lock-in effect, which Logan Motoshami of Housing Wire pushes back on the language. Again, I think it's a nuanced argument. I think they're saying the same thing. The people who normally would buy cannot afford it. That's the big, that's the big issue right now. Because I still think there are sellers out there, and this is why the lock-in effect makes sense. There are sellers in there that are like locking down because they can't afford the house they want. They have a desire and a want and to make a move, but 7.3, nearing 7.5 is making it harder for them to do that. So buyers and sellers are at a standoff. There's a new Redfin report that we covered yesterday, found the share of $1 million homes is now 1 out of 10, close to 1 out of 10 homes in America. We covered that on yesterday's hot sheet. You can go re-listen to that. As home prices remain elevated, the new home construction stays struggling, as recent data from NAHB going down 6 points, which we covered yesterday as well. The combination of home prices and mortgage rates puts a real crimp on average home buyer who typically moves into a bigger space. We didn't feel the effect immediately through 2020 to 22 because so many Americans have moved to less expensive cities. But now there is a more return to the office. We are seeing more people trying to afford Seattle, Denver, Portland, Dallas, and struggling to do it. Okay, so we need to build more houses. Of course, we need to build more houses. That's not going to it's not going to help us in the near immediate future. Okay, but now if I'm a real estate professional, where are the opportunities for me? Because listen, this stream sounds like a lot of pessimism, right? But these are just the numbers. These are the data. I can't change them. They are what they are. But how do we avoid feeling like millennials? Fortune has a headline here that says today, millennials are so worried about their finances, they're falling into depression. Millennials, my fellow millennials, I promise you, if you use that time that you're spending looking out the window at the rain and get to work on something, you're going to be just fine. Okay. There may be a time period, a season, a couple of years right now where everybody's got to work more than a 40-hour work week. I know that that's like not cool to say anymore, and everybody wants less hours and more money, but that's not the reality. Okay. So you might have to wake up and put in more work so that you're not depressed about your finances. Okay. Start to really dig deep into the stuff that you do, get your hands dirty again and do the work. And just a crazy thought, maybe get a side job, do something that can give you the energy and ambition to not be depressed about your finances. Staring out the window's not going to do it. But what are the opportunities for real estate agents? If this is the way that millennials are feeling, depressed, where should you focus your attention on? Okay, we showed this chart yesterday. I'll put it back in the daily downloads today. Millennials passed the silent generation for home values, but what we didn't really focus on, and what I've been talking about for the last couple of years, while everybody's like got all juiced up on how do I relate to millennials? They're now the biggest home buyer. And I kept saying, hey, certainly you want to be relatable to millennials, but I'd put most of my eggs in the basket of baby boomers. Okay. Baby boomers right now control $18 trillion worth of real estate. Baby boomers control 1/7 of the world's wealth. Not the countries, not North America's, the entire world's. It's 70 plus million people control 1/7 of the world's wealth. Who is going to be least impacted by 7.25%, 7.5%, 8%, call it 8.5%, 30-year fixed mortgage rates? Jim Cramer on CNBC this morning said he thinks 7% mortgage rates, because if you look at the history of them, are very normal, that this means we have a strong economy. This is a good sign. Okay. He's all about a high 10-year and a high 30-year. I mean, it is happening at a time where the economy is rip roaring. Home prices happen to be at a spot where they're just not affordable for many people. They're affordable for baby boomers who control 1/7 of the world's wealth, have $18 trillion in real estate, many of which make up those 42% of homeowners that don't have a mortgage and wouldn't have a mortgage on their next purchase. I'm just saying, as an agent, as a real estate professional, I want more baby boomer friends than anybody. The next 10 years offer a lot of movement on, like Glenn Kelman says right now, limited transactions that are happening. We know that the baby boomer is going to be the biggest buyer here in 2023. We know the market's slowing down. Are your chips heavily going in that direction? Or are you waiting for, 15 years out when millennials are in the power position? Boomers aren't going anywhere. They're spending a lot of money. They're buying second homes. So that's, to me, the optimism. If I'm going to be optimistic about the next 6 months, it means I've got a preparation, a plan in place to really go after that baby boomer segment of my market, that I'm really paying attention to the baby boomers who control $18 trillion in housing alone. It's more than triple the amount owned by millennials. So those are the folks that I really want to pay attention to. This lower transaction number, just being optimistic that all of a sudden there's going to be some light switch and the 30 year is going to come down, and that we're going to get back to something that we've seen the last couple of years. That's not happening. It's not happening. Lower transactions for longer, higher interest rates for longer. As a real estate agent, be prepared for that. And then, here's another reality check. Logan Motoshami from Housing Wire. This is real time, 4.3 on the 10-year. This is not great, okay, for affordability. 4.3 on the 10-year. Logan Motoshami predicted the beginning of this year that we would not cross 4.2, 4.25 range at all this year. Obviously wrong. 4.3. It can go higher. Certainly can. Look at the rip we've been on here just the last 5 days alone on the 10-year. Expect today to hit a new year-to-date 30-year fixed high, a 20-plus year 30-year fixed high, exceeding last year's 7.37. We ended the day at 7.34 yesterday. It's going to happen. As a real estate professional, you've got a couple of options. It's head in the sand and like it's going to switch up, and we're going to have one of those big drops on the 30-year fixed and get a couple of deals going, or we can have a long-term sustainable plan, understanding that it's going to be lower transactions for longer and generally higher rates for longer, higher than what we've been accustomed to the last 5 years. And to me, that means going and really focusing in on that baby boomer demographic. All right. One way to keep your head out of the sand is to be in Dallas this time next week. I'll be there, and there's last call on Tom Ferry tickets, Tom Ferry Summit tickets, which is happening next Tuesday through Thursday. If you want to make a last-minute decision, you use code PRBAMSS, PRBAMSS for the Tom. Get $100 off your Tom Ferry Summit ticket. Use code HOT, of course, to get 10% off of BAMX, where all the daily downloads from this show are living in there. I've got some good ones here today, including this one, which I didn't share on the show, but I do want to bring to your attention: the housing as a percentage of GDP. This is what real estate professionals, housing and cost of utilities, furniture repairs, maintenance, construction, this is what we're dealing with. Almost a 20% share of GDP. This is what we're responsible for. And right now, in a time of economic squeeze, affordability squeeze, like we've never seen, the most unaffordable point in the last 20 years, since the great financial crisis, of course, for housing. It's real estate professionals' responsibility to probably expand hours more than what you're comfortable with, to probably put in more to serve your communities. This is what we're responsible for, a significant portion. And if the GDP is going up 6%, again, that won't be good for maybe what they're going to do with the interest rate, but this is a real situation. So that'll be down below in the daily downloads. Of course, you get 10% using the code HOT, and you get 25% off of BAM Camp happening on September 20th, which is going to be an epic event. Tomorrow, Friday, we're doing free format Friday. So Bobby has been supposedly collecting comments. Thank you guys for all of your comments. Really appreciate the live comments. And don't be afraid to leave. If you're watching the replay on YouTube, don't be afraid to leave comments there either. I'll check those as well. But Bobby is collecting comments for Friday's show, free format Friday. So we're going to go over some of the questions or some of the comments from the week. If there's breaking news tomorrow, of course, we will, we'll cover that. But it's going to be a little bit of a new show, new style, free format Friday. Not tomorrow, but we're working on it where we're actually going to be able to take call-ins on free format Friday. So a lot coming up here on the hot sheet. Hope everybody has a productive day. Preparation is the best form of optimism. So get prepared for what's coming. I think we can see what's ahead. We experienced it last quarter four. It might just be similar or worse this quarter four. No problem. We made it through the last one. We'll make it through this one as real estate professionals. And I'll see you back here tomorrow on free format Friday version of the hot sheet. Until then, toodaloo.